All right, eel nerds, we are off to episode 75. And, as the topic indicates, I thought we'd start talking more about value investing. And I wish things were as simple as this is how you go for the right way and this is how you go for the wrong way. It is more like the sign at the bottom where you learn and you make some turns and you figure out what works and what doesn't. Couple of new things for new subscribers. Thank you for signing up. There is a playlist and it organizes things in numerical order. It is the best way for you to follow the show. My usual disclaimers: this is not investment advice, tax advice. I am not a stockbroker. I do not make any money whether you buy or don't buy any product. I'm not here to pitch secret sauce and t-shirts, and this is not about product or politics either. I am sharing my education. All right, let's take a look at today's agenda. As always, we're going to look at the macroeconomic background of where we are, and from there, understand whether it makes sense to launch into value investing and how much to do and how much not to do, and look at a couple of guidelines. I'm going to review a couple of case studies and how far these have come along, and we're going to end with how do we plan for the next 90 days. All right. Background, we all know, old news by now. The Fed keeps saying they're going to fight inflation until it is about 2%. The exact number is unknown. It may be 3%, but it does not look like the fight is over. We may be at peak interest rates, we may be very close to it, but that doesn't mean that the rates are going to drop anytime soon. Employment is at a multi-decade high. We still have inflation in certain sectors. And so the market sometimes, depending on the day, the market thinks, ooh, we're going to reach a soft landing. What does that really mean? There is an episode specific to soft landing. Take a look at that. And the idea being that you would still keep full employment and somehow tame inflation. Maybe it'll happen. It's a miracle if it does, but there are financial stresses on the economy, so who knows where it is going to go. Yield SuperBowl, our usual topic. Let's see where we are. Let's take stock at where the fixed income side of the house is. And for those of you who don't know what we do with Yield SuperBowl, we take a look at the most popular fixed income securities: treasuries, agencies, munis, corporates. Well, we take a look at bank CDs, but there was only one time that they ever were attractive. And we then stack each one of these for the same duration, including bank CDs, and we tax adjust them. And there are prior episodes that talk about tax adjustment. I won't dwell upon those now. And there are certain agencies that are taxable fully, so you got to be careful. There are certain states where munis are taxable, and we will be using effective tax and not marginal tax. I am glossing over a lot of detail. There are prior episodes that review these topics in great detail. So are you ready for the Yield SuperBowl now? Here you go. What does that say? It says that in the short term, less than 9 months, treasuries are where the the action is. And anything past 9 months, agency bonds, which are callable, continuously callable, and they are where the action is. And as you can see, treasuries have a very steep drop off after the 9 month duration. So, you can increase duration, but the odds of getting a really attractive yield are slipping by the day. This is despite the fact that the Fed may increase short-term interest rates. So that's a pretty interesting observation. And then if we dwell deeper, where do we go? And to put that in a showcase, I thought I would compare the yields today versus 2 weeks ago to take a little ride and see where we are. 2 weeks ago, you can see that treasuries were pretty close to 6%, and agencies were giving well above 6%, especially in the longer durations. And just the passage of 2 weeks, it's hard to tell here, but given the scale, treasury yields have actually dropped. It's counterintuitive, but it is happening. Treasury yields are dropping in the less than 9 month range, and agency yields are cratering in the greater than 9 month range. And so if you thought you could get 6.25% that looks like a dream. We can no longer get those kinds of yields. And so the market is effectively asking you to, accept something like a 5.5%. Remember, that is adding state tax. So something in the 5.25 plus state tax is what the market is paying for treasuries. You want anything more than that, you have to take risk, is the message. So what is the conclusion? If you have a pocket of money that you do not need for 2 years or so, and you want to keep the highest yield possible, then you may need to increase duration. And that is the nature of where we are. To the extent that you can find value stocks that you believe are not going to crater, if indeed all the calculations are wrong and the equity market crashes, you may want to start looking at value investing. Rash moves are not my style. You do you. I try to do more analysis before I act, and I'm very comfortable with not participating in the first few months of an alleged rally in the stock market. I'm good with being slow and steady. So, having said all of that, where do we go for value investing? Couple of quick reminders. What is a good value investment? The first thing is you don't look at companies that are jacked up on debt. Those will have problems. They have to pay interest. Money is not available to pay dividends. Money is not available to invest in growth. And so, ideally, no debt. But if there is debt, a very low debt, the industry average for debt to equity ratio used to be 15%. Today it is 30%. And so something less than 30 is really what you're looking for. Enterprise value, there are previous episodes that cover that. We're looking for, companies that have a lot of cash in the bank, not a whole lot of debt. And we don't like very high PE ratios. The average is north of 20, which I think is pretty rich as an average. And so I like to look at PE ratios that are 10 or below to look at what that gives me. And while I'm at the low PE ratio, I also would like the business to have huge cash flows so the management can say, do we want to do stock buybacks? Do I want to do a dividend? Do I want to do an acquisition? So when you have high cash flow, then you get to play those kind of strategies. And if the cash flow is high, I would also not like to pay a very high price to cash flow ratio. So that should also be there. And this may look like a wish list that is beyond the pale. You may think nothing will ever satisfy all of these, and you will be surprised. If you're patient, you will find good ones. So here's how I would set up the screener, and I'm using Schwab. You can use whatever you want. And as you can see, I only look at domestic stocks. That's just me. ADRs have additional fees, and you also pay international taxes on dividends from international stocks. So I just, out of the gate, I just say I'm not buying any non-American stock. You do you. And I look for high volume, low debt, high cash flow per share, high dividends, and also a very high coverage ratio. And when you narrow all of that down, you get a really small set of answers. And so I am going to go into case studies, and I want to make sure that I make it very, very clear. I'm not asking you to buy. I'm sharing my education. You do you. I may own positions in this. I certainly am not looking to retire because you're going to buy it or you're going to sell it. So this is just education. Warning again. We looked at two in the previous episode, Mueller Industries and Evolution Petroleum, and we looked at why they were value stocks. Now we're going to look at two more. Here is number 3. This is Chesapeake Energy. Chesapeake Energy, just looking at that picture, market cap 11 billion, enterprise value 12.8, that alone tells you they have some debt in the books. So that's the very first thing. It's not a whole lot of debt, but they definitely have debt in the books. Their PE ratio is really, really low. However, utility companies also have low PE ratios. Having said that, if you compare it to their peers, and TPL is one of their peers, it appears that their PE ratio is low. Now, why does this kind of stick out? The reality is their ordinary dividends are 2.8%, nothing to write home about. but they have sometimes 8 and 9% extra dividends and special dividends. And when you add all of that up, Chesapeake Bay looks absolutely insane. They have a debt to equity ratio of 20. Remember, the market has a debt to equity ratio of 30, and peers of Chesapeake Energy have much higher debt to equity ratios. So bottom line is their cash flow and cash are not incredible, but they do have a very good cash flow margin. Their dividend coverage ratio is very healthy. So this kind of is a cheap stock that runs into a lot of cash, and management tends to pay them off as dividends. Doesn't mean it is going to continue, but it will check all the boxes as a value stock. You do you. Think twice, thrice before you buy. Here is another one. I indeed own this, and this is one of my very interesting case studies. And if you look at the pricing history, you will see that it has had a very rough ride in the sense that it reached a meteoric high and it is coming back to earth. But there are some dynamics going on here. Calm is Calmain Foods. They own farms, chicken farms, and they sell eggs. And if you can very quickly see here, their market cap is 2.18 billion, enterprise value of 1.5 billion. That tells you that they have 600 million or 700 million more in cash than they really need for operations. So they are sitting on a huge pile of cash. Their PE ratio is pretty low. And again, they have comparables and you should do your own homework. They pay qualified dividends that are very, very high, but who knows whether it can be sustained. They need to continue making the kind of margins they are making to afford those dividends. And if you look at their debt to equity ratio, they got nothing, no debt on the books. Their current last quarter's numbers are through the roof compared to their peers. They have plenty of money to pay these dividends. The real question is, will egg prices continue to stay at or above norm so they can pay the kind of dividends they are paying? And what happens if indeed there is a recession? What happens to egg prices? And the egg is not exactly a commodity, but it is a food item. And you may remember food and energy are not included in the usual inflation calculation. So depending on how the wind blows, Calmain may make you a huge amount of money in qualified dividends, or it may be bust. So use your own instincts. All right, having said that, should we just buy that and buy every other equity? And do we have an all clear to accelerate on equities? I am not going to do that. That is just me. And here is why. We talked about this a handful of weeks ago. We signed the bipartisan debt ceiling bill that allowed us to borrow. However, we do not have permission to spend. The permission to spend will need to get granted before September 30th. If permission to spend is not granted, then there will be a government shutdown and there will be an equity crash. In other words, there may be an opportunity for us to get back into the equity market right around the beginning of October. If indeed there is a shutdown, then there will be a lot of jitters. And if there is no shutdown, we kind of move into the next phase of it. There could be a bipartisan omnibus bill which averts the shutdown, but in today's world, bipartisan, doesn't usually happen. So who knows? Bottom line is there is some volatility coming in a few weeks. So what does it mean between now and September 30th? My strategy is to keep a good chunk of dry powder handy on or around October 1st. And if something has an incredible value play, I might buy it. But 90 cents of the dollar, I am still putting on really short-term treasuries, waiting for the October timeframe to figure out what I want to do. That is me. You do you. Questions, comments to Badri. I'm an yieldnerd at gmail.com. Thank you so much.